David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm. It's now time for User-Friendly Finance with Dave Weaver from SWC Wealth Management on News Radio WHP 580. If you have a question for Dave, call 540-0580. Now with today's show, here's Dave Weaver.
Hi, this is Dave Weaver with SWC Wealth and User-Friendly Finance, and we're coming back with another issue. Today we're going to talk about something that's near and dear to our hearts, the 8 wealth management issues. And I think every financial firm has some kind of structure to their financial planning process, but this is ours, so we'll give you an idea of the process that we go through. Joining me today is Tom Pop. Tom's ordinarily in our Carlisle office, but joining us here today.
Morning.
Good morning. How are you today?
Doing well, thanks.
Well is good.
Yep.
Okay. And we have, again, we have 2 offices. We're in Carlisle at 35 East High Street, and Megan, who's on here sometimes, Megan Wall. Tom and Megan both are typically there, but spend a day or two in Palmyra. And I'm typically in the Palmyra office, but spend a day or two in Carlisle. All depends on what's going on and the time of the season. Both offices were pretty much 8 to 4:30, and then by appointment. And we do evening appointments and weekend appointments if it's required, or if that's the only time they can meet. But anyway, again, our primary number is 717-706-0700, or you can reach us via the web at swcwealth.com. We keep threatening that our new website will be up and working soon. I think we're making some progress.
It's getting there.
It's getting there. I would say probably not before February 1st at this point.
Well past that, I think.
Yeah, I think we're well past February 1st. So at this point, my current target is hopefully February 28th, no later than the end of the month. At this point, it should be further along. I think just like we've talked about on the show, a lot of the stuff that we do has to go through some additional scrutiny that an average website wouldn't go through, because we have to make sure that everything we say is compliant from a regulatory standpoint, can pass muster with FINRA. First our broker-dealer, then with FINRA, and sometimes that takes a little bit of manipulation of the words or adjustment of how things are presented. But anyway, we should have that relatively soon. And I think it's just a matter of time at this point. That's what I'm thinking. Just a matter of time.
Just a matter of time.
Just trying to be patient. And in conjunction with that, we're going to be making some other changes, which we'll probably announce here in the next couple of weeks. But, for now, everything is the same. You can still reach our website at swcwealth.com. You can still reach us at our primary number at 717-706-0700. And feel free to give us a call or send us an email if you have any questions, anything we don't cover on the show that you want to make sure we cover, if you have future topics you want us to cover. Our thought at this point is that we're going to today start with the overall structure of what we deem the 8 wealth management issues, and then each week for the next 8 weeks, or we may have an interjection in there at one point for taxes, or maybe a couple points for taxes if people have tax questions. But do an overview of the 8 wealth management issues, and then we'll go and cover the other, each one individually as we go through the next couple of months. If you want to join us on the show today, you can give us a call at 717-540-0580 or 800-724-5801. We have the $10 Panera gift cards if you get on the show. And again, this is more about the general financial planning process and the things that we take into account when we look at financial planning and the process that we go through. So I think we've tried to set a framework as we went into the year of going back, relooking at your goals, your financial roadmap that you've set for yourself during the year. What are your targets, debt reduction or savings for either retirement or any specific things that you have. All these are incorporated within the 8 wealth management issues. Then we talked about budgeting in a little bit of detail so that you could start to get a handle on your own spending, because spending is kind of the cornerstone of where we are with budgeting. Everybody's got a slightly different situation. I just met with somebody yesterday who had a lot of regular income, but a huge amount of debt that was sort of swallowing him up. And in that person's case, having a large amount of money isn't necessarily going to get him the retirement that he wants. And people that sometimes have modest means have the best chance of making it comfortably through retirement if you can survive on both you and your wife's Social Security with some supplemental savings from either a pension or investments that you have. Then it may be easier for you to actually achieve the goals that you have than somebody who has like a moderate amount of money but has loftier goals. Mm-hmm. So it's just something to keep in mind. So anyway, we kind of trying to lay the framework of get your house in order, come up with some high-level goals, do your detailed budget, and now we're going to talk about going back and revisiting what is the framework that you want to use to create your own personal financial plan. So I'm not sure, Tom, what do you think is the best way to try to go through this?
Well, I think we could just go ahead and run through our 8 wealth management issues as defined and just briefly go over each one, and then we can start delving into more of the first one, the investment management side, if we can get through it today. It's probably one of our larger areas or that we deal with a lot.
Is that one that we have compliance approval for yet?
Yes.
Okay, good.
We're good to go.
I just want to make sure.
Yeah, that's important.
Yeah, it is important.
Yeah, so I think when it comes to the 8 wealth management issues, we take a holistic approach to our clients' finances, and we look at each of these different areas, and they work together in a lot of ways, and it's important for us and also important for the client to really have an understanding of these, and then also to address them as they come up, or even just to get ahead of it, to keep it in front of the client in the event that they do come up, because we found that throughout our clients' lives, they will potentially experience all of these at some point in their life. So,
yeah, and again, it's meant to be a
sort of a process and framework.
Yeah, process and framework. And, we talked a couple of weeks ago about trying to go into the more ultimately we're going to be modifying our name a little bit to include the True North concept, which is having a principle-based or focused approach to life, including your financial life. And all these, as you start to get these in line, are part of making sure that the things that you're doing in your daily life align with what those things are. One of the things that was very important to this person yesterday was education planning, and he's making some huge sacrifices for education for his kids. Not everybody has a plan. And my brother, as an example, when he first started out with his kids in college, when he first had his first kids, he started immediately with college planning, and as he had, eventually had 2 more kids, it was always a primary focus for education planning. But
that's always an important goal.
Yeah, it is. It isn't always. I mean, it's a goal. You want to make sure your kids are educated, but you don't necessarily have the goal of paying for it.
Right.
You may have the goal of educating your kids.
Other things come in the way before that, usually.
Yeah, retirement planning or tax planning, or it could be any one of it.
It's not necessarily the top priority, but it's definitely, at least for me, it was important to start it. But
it is. It's important to get started. It's important to keep something in place. It's important to have your mission for what your kids' education is. Figure out what it is. That's important. Okay, so what's our first wealth?
So the first one is investment management, and that simply means your stocks, bonds, mutual funds, CDs, investments that you have outside of your retirement accounts. And that's, when we talk about that, we talk about your goals, your time horizon, your expected return, and we'll get into more detail in that specific area towards the end of today's show and maybe even next week.
Okay. Well, let's take a break there.
We'll take a break at that first one.
Yeah, we'll take a break right there, and then we'll come back and talk a little bit more. Thanks.
Let's get back to User-Friendly Finance with Dave Weaver on News Radio WHP 580.
Hi, this is Dave Weaver again with User-Friendly Finance and SWC Wealth Management. And we were talking before the break about how we're going to start talking about the 8 wealth management issues. So today we'll talk about an overall framework for what those 8 issues are, and then start into the first one, which is investment management. If you have any calls today, if you want to give us a call at 540-0580 or 800-724-5801 as we're going through this process, feel free to interject or ask questions. If you get on, we have that $10 Panera gift card, although I keep saying where you may have to change to somebody else. I'm not sure where else is quite as ubiquitous as Panera, but we'll think of something.
Yeah.
If there's something that people can think of, just send us an email and we'll try to change that up with that. So, okay, why don't I'll just, I don't know, Tom, do you want to go through the first four and then I'll go through the last
Sure,
four just
yeah.
with what they are?
So the first one I mentioned was investment management, and that's simply your stocks, bonds, mutual funds, CDs, etc. These are your investments, and we really talk about your return expectations, time horizon, and risk profile, as well as your goals for those investments. The second one is a cash.
Oh, before you.
Oh, I'm
just,
sorry.
No, just one thing, because I know we're going to get into investment management.
Yeah.
One thing in our firm, and we believe that financial planning is more than investment management. So if you read a little bit more today about they call them robo advisors or robo whatever, they have various different names for automated trading that takes place to either keep an account of balance or you do a questionnaire and fill out a formula. They calculate a formula for how you should be invested. Investment management to us is not the only thing that we're providing. It's a whole process that involves creating your financial plan, and investment management is just one small part of it. It may not be an eighth of the plan. Maybe it's a little bit more, maybe it's a little bit less, and it varies as to what's important. The markets go up and down every day, and you want to make sure that you are appropriately invested for your risk tolerance and your time horizon. But it's not the only thing that we do, and there are other aspects of engaging with financial planning firm or an advisor than just doing the
Just
investments.
the investment side.
Right.
Yeah.
So, okay, sorry.
No,
I
it was a
digressed.
good point. And on top of that, we also cash flow and debt management, and this is basically how much income you have coming in compared to how much outstanding debt you have, and that's important. We look at the budget as the foundation for your financial plan. So really getting a handle on your cash flow needs, and also trying to help, like you said earlier, with the client that you met with debt management.
Yeah, and what we had, that's part of the reason we started this year at the beginning of the year with so let's start with your framework of your high level goals, and then look at your personal budget, see if you're on track to accomplish the goals, if you've got them set, and then now we'll be trying to back and redefine those goals as we go through the year.
Yep.
Okay.
So then family risk management, that's essentially assurance planning.
That's not liking your in-laws?
That's
I
one way
like
to look
my
at
in-laws.
it.
I like my
I do
in-laws.
too. Yeah, it's insurance planning, long-term care, disability, and life insurance, and that's always important. A lot of people leave that out of their plan, but making sure that you're properly insured can be very important. And then retirement planning is the fourth one, and that's a large part of our practice. It means making sure that you have a clear picture of what your retirement will look like and how you'll be doing, and will your money last, and that's what a lot of people come to us about retirement planning. We're doing another retirement seminar in March. We'll announce that one when it gets closer. And then Dave, what are the next five?
The next five, but there should only be four.
Next four.
So the next four of the 8 wealth management issues are education planning. Education planning, a lot of people come to us and talk about education, but it's trying to fund your children or grandchildren's educations, creating a vision for what you want their education to be, like we were talking right after as we came out of the break. What do you envision for educating your kids? Everybody has, when they first have kids, has a idea that they're going to educate their kids, but does that involve paying fully for college or technical school or anything like that? Or you just don't want to have your kids surprised when they're juniors in high school and find out that they have no money put aside for college. And that's fine if that's your plan. It's just your kids should know it too. But education planning is important. Legacy planning, it falls generally under the realm of estate planning. And one of the things that we always have to explain is the goal what's your intent for what you want to leave left for the people behind you, whether it's creating a legacy for your kids, donating to a charity, creating a foundation. There are a bunch of different things that you can do as part of legacy planning. Some of it's just avoiding taxes, estate taxes or inheritance taxes. Now that the inheritance tax is $11 million, it affects fewer and fewer people. Plus, it's transferable, so now you're up to 22 million people for federal estate planning. They just recently are talking about a change to the Pennsylvania inheritance tax rules, which we'll cover when we get to a legacy planning. But you want to make sure you understand those rules and make sure your wishes are being carried out at your final passing. And some of that can take place before you pass. Maybe you want to have your kids inherit money while you're still alive so you can actually get to see them enjoy it. That's also part of legacy planning. And then we have business planning, which is making sure that any plans for your business that you own or thinking about starting, it can include things such as retirement plans, business insurance. If you have, when we talk about retirement plans, the plan you set up for you or your employees, and it can be different depending on how much you want to fund for yourself as opposed to your employees. Some of the rules are different for different types of plans. A business insurance, if you have a partner, creating buy-sell agreements so that if something happens to one partner, the other partner's family is taken care of, or if one person just wants to get out, if there's a way to fund buying that person out. And then our eighth broad area is special situations, and that can be just about anything. We have people that want to do all kinds of things as they go through life, whether it's buying a boat, buying a second house, putting in a kitchen, putting in a bathroom. All those things are big expenses that are a little unusual. RV, weddings. Good golly, I don't know how much weddings can cost now. Probably $40,000 or $50,000 more, I guess, depending on what your intent is.
How you do it.
Or it can be a couple $1,000 bucks. It can be a couple $100. It's whatever you want to plan for and think about. Again, wedding planning is sort of like education planning. You may have an idea in your mind, but if you don't plan it and fund it, it's not going to happen maybe the way you want. And then Tom and I were talking on the break. One of the things we don't have is one of our 8, but kind of overlays over the top of these is tax planning, which is something that we do in our firm to make sure that whatever plans you have are done tax efficiently in a way that puts the most money in your pocket, as little money in the government's as possible. We don't advocate that you cheat on your taxes at all. You want to do whatever you can within the rules to keep the most money in your pocket and the least money in the federal government's pocket. It's ultimately, in the end, you're the one that you want to have get the benefit of your money. You and your heirs, you want to have to get the benefit of your money. If the government gets it, they will spend it. And if you get it, you'd have a chance to spend it. So as much as you can keep in your own pocket as possible, probably the better. So that's the overall framework of the 8 wealth management issues. And again, I think it ties really nicely into our concept of the True North that we're going to try to get and develop. And you can see it pretty much encompasses all the various areas of your life and the things that are important to you. Family risk management, it starts right with all of it, actually, from 1 through 8 have to do with creating a vision of where you want you and your wife or you and your family to head, both now as you're living your working life or a young family and working life, and then retirement, educating your kids, things that you want to try to accomplish in your life, and things you want to have happen when you pass. So I think the True North concept, if you create a thought or pattern for how you want to live your life, I think that'll naturally translate into the plan that you're going to create. And even cash flow and debt management. A lot of people don't have the same common philosophy about family and debt management, or cash flow and debt management, which can cause a lot of conflicts in a business. It can be, if you have 2 partners who disagree about debt, it can be a huge conflict. If you have a husband and wife that disagree about debt, it can be a huge problem. So anyway, coming up with a framework that works for you, find your own internal compass, and go from there.
Yep.
So with that, do you want to start talking about the investment management?
Sure. So the first one of our 8 wealth management issues is investment management. And as Dave talked about earlier, it's not the only thing we do, but it's certainly a very important part of the overall process. But it's basically understanding your investments and creating a strategy designed to meet your unique financial goals. And some of the things that we consider while creating an investment plan, I think the first thing is really to define what your investment goals are. I think that is the foundation for creating an investment plan. So a lot of times people might not have a goal set aside for their money. So if they come to visit us, they might set an appointment up and they've inherited money, or they're starting to invest for the first time, or they've accumulated a lot of money in cash. And the first thing we ask them is, what is this for?
It's more than I want to make a lot of money and never want to lose.
Right. Exactly. Is this for retirement? Is this for buying a house? What the goal really helps define the rest of the process in terms of then figuring out the time horizon, the risk, and what we often find too is that sometimes the investments are not matched up with the goals, and you might have somebody that's trying to save for retirement and their money's all in CDs, and that's just not going to work, or they're looking to invest money to put for a down payment on a house, and they're all invested in the S&P 500 index, and they need the money in 6 months. So a lot of times those are not aligned. So once we get that goal, then we can then figure out the next step.
Okay. With that, we'll come back after the break. This is Dave Weaver and Tom Pop from SWC Wealth Management on User Friendly Finance. Give us a call, 540-0580 or 800-724-5801.
To reach SWC Wealth Management, contact their offices at 706-0700. Now back to the show.
Hi, this is Dave Weaver again with Tom Pop and SWC Wealth Management, bringing you user-friendly finance. We're talking about our 8 wealth management issues and the subject, trying to tie that into our True North process that we're going to be going through. But we're starting off with going through investment management, which again, it's just a small part of the service that we provide, or it's a part. It's just one of many pieces. And if your financial advisor is only addressing just the investment part of your financial goals, then you're probably not getting all the service that you need to support the goals that you have, because you need to explore the goals to try to find out what the source of the money is, what your intent is over time. They may cover risk tolerance and time horizon, but they may not cover what the intent of your money is, and that helps to decide how much risk you should take on. And you may not think in that context as you're trying to develop, lay out how you're invested. A lot of times people will say, "Well, I just did what the guy told me," without really understanding what they told anybody. Somebody will ask them questions and they'll provide answers, but. Anyway, I guess the first thing that you want to consider, oh, by the way, if you want to call in 540-0580 or 800-724-5801. So I guess the first thing, and one of the things that we cover with our clients, and we have a questionnaire where we go through some of these things, but the first thing is, what's the primary goal for your money? And really, when you start by what's the time frame that you're going to need that money? Is it something you're going to need? To what Tom was saying before, if you want to buy a house in 2 years, you don't want to have your money invested in assets that are longer term assets and take on more risk. If you know you're going to need, 25,000 hours to buy a house in 2 years, you don't want to be investing in something that's not going to have
too risky or speculative.
That'll leave you 25,000 hours in 2 years.
Yeah.
If that's truly your goal, then you can't be investing in that. So generally the time horizons, we kind of work in windows. There are a bunch of different ways to approach this, and different people do it a little bit differently. Some people have buckets that determine different uses for, like, you might have one bucket for new house money. You might have one bucket that's retirement money. You might have another bucket for a house at the beach. You have different
or education
buckets.
Spend
Education,
something sort of medium term. Yeah.
But you have like short, medium, and long term goals. But usually you want to try to figure out what it is you're trying to accomplish, and then develop a time frame so you understand that you have money that you're going to need in 5 years or less, or 10 years or less, or maybe for more than 10 years. So that's considered your time horizon. And that's one of the key factors when you're trying to figure out how long money should be invested and how much risk you take on.
Yeah, it's really defining your goals is the first step. Time horizon comes second. And then with that also, I guess the next thing would be then to also cover your return expectations. So if you have a time horizon of 2 years and you want the money to grow at 3% a year, then you can help. That helps kind of define also what what investment you should be in, or if you're looking at something long term and you need to make 7 or 8% a year to get to that goal in 30 years, then that should help determine where you should be allocated as well.
And some people don't understand the velocity of money or how money accumulates over time.
Mm-hmm.
There are a lot of little articles that you'll see in different places that'll say if you start when you're 25 and invest $100 a paycheck for your entire work career, you'll have $5 or $6 million by the end. Or, there's various articles along those lines, but you have to start and you have to have a reasonable expectation of what the returns are going to be that you're targeting and how long it's going to be before you need the money.
Yep.
So one of the next things that we try to look at with people is, and again, there are different ways to ask people this as well, but we usually start with, would you consider yourself conservative, moderate, or aggressive? And sometimes by the time we've covered the first couple of things, you already have an idea of whether they're conservative, moderate, or aggressive. I like to try to get one of them ruled out, and usually rule out either conservative or aggressive.
Right. Yeah, I think most people fall in the middle.
Yeah. Most people fall in the middle, and the people that are definitely not aggressive usually don't drift that way as you talk more.
Right.
And the people that are conservative don't usually get aggressive by the end.
That's true.
Conservatives get moderate, and moderates can go either way, and aggressive people may go down a little bit, but they won't go down dramatically. Mm-hmm. Risk takers are risk takers.
Yeah, and risk is also a very important thing when we're coming up with the investment plan, obviously. And I think now people, I think, in today's market have been a little complacent with risk and forgetting that markets can also go down as well as go up. So how well you're able to stomach volatility is very important. If you can't sleep at night if the market's going up or down over the course of a year, but at the end of the year it's still positive, or at least you're still on track for your goals, then maybe you should be more conservative.
And we were talking last week, and I was saying that I like sometimes when people actually have a little bit of a downturn when they first start an account, because when people start with 2 or 3 years of upturn, mm-hmm. and then their account goes down, they panic. Where they start with downturn and understand that it can also go up, and then it does go up. Eventually, the markets go up. They go up and down every day, more up than down over time. But it's not that I would prefer that people lose money right when they start to invest, but if you understand right away that you can lose, mm-hmm. that there's some expectation of loss, there should be, because it's not every investment is going to make money all the time. Cash doesn't always win. Stocks don't always win.
Yeah, and we've been kind of in this really interesting time where we've had positive growth month over month for the last 12 months.
Well, probably we're in like a 10-year bull run.
And a 10-year bull market.
Which is one of the longest ever. So
we haven't really had well, I think our last correction was in...
We had the first quarter of 16.
Yeah.
We went down 11.5% in the first 6 weeks.
So about 2 years ago, essentially.
But the markets go up and down. They go down, up and down every day, and you have to understand how much risk you are willing to take. And nobody in general can guarantee your return. There are some products that have a guaranteed type of return, but in general, if somebody tells you can invest in the stock market with a guaranteed rate of return, there's probably something amok.
And there are other investments out there that variable annuities, fixed index annuities that do offer a certain level of guarantee to help protect from the downside. And sometimes those are appropriate for investors, sometimes they're not.
Yeah, and the thing that you have to keep in mind is in order to take risk off of the table, you'll have constraints on your returns. Mm-hmm. Just like a savings account will always be one of the lowest returning assets, and certain higher risk equities over a long period of time will have a higher return. In order to take that risk off the table, you're going to constrain the amount of return that you can get, because the company that's backing you, or however you're getting backed to take down your risk, is going to limit your return to try to make sure that they can pay you whatever they say mm-hmm. they're going to pay you.
Yeah, and you want to make sure that is aligned in terms of your risk and return, and that you are taking on the appropriate amount of risk for the appropriate amount of return, and that it's not somehow mixed up where you're taking on too much risk and not getting the return, or you're taking on not very much risk and getting a very high return, and that, maybe something's wrong there as well. So,
yeah, always go in with your eyes open.
Yep.
And, we've talked about this before on the show, but it's really important to find somebody that you trust that understands what your risk tolerance truly is. And they can help you guide through that process to make you have a better understanding of what it is. Because I think in general, people just really don't understand the trade-offs between risk and return.
Mm-hmm.
Even in a bank where you're not getting not much return, that still has a lot of risk in terms of purchasing power over time. So you just have to understand where the risk is that you're taking on.
Certainly. There's inflation risk. There's purchasing power risk. There's all kinds of different variations of risk. It's not all just market risk.
Yeah. So try to get a good understanding of what they are and how those affect your risk tolerance. We have a question that's been in our last two versions of our risk profile questionnaire that we use with our clients, which I think is a pretty interesting one. 6 months after you make a $100,000 investment, it decreases by $10,000 in value by $10,000 in a down market. How would you feel? I don't think anybody would feel great.
No, most people, I think, that's a 10% loss in a year or in 6 months. That doesn't feel good.
Yeah.
And people look at it differently. You might look at what happened on Friday as something that would be a time to buy, or maybe it's something that worries you.
Well, yeah, like in the case that we were talking about before, there are conservatives and people that are more aggressive. Like, somebody who's truly conservative would not be comfortable with a $10,000 loss in 6 months. Somebody that's aggressive might, be to your point, might say, "Wow, this is a great time to buy. It's gone down 10%. I think I'm going to get in." And people sometimes need hand-holding through that process to help them figure out where they are with relation to that decision. Sometimes it still may be you want to understand the implications of staying with that investment long-term. And if you're a moderate, you may be more easily persuaded one way or the other to either get rid of it or to purchase some more. Anyway, with that, we'll take a break. This is Dave Weaver and Tom Pop with User Friendly Finance, continuing our discussion of investment risk and investment as a portion of the services that you should be looking for in RA wealth management issues.
Welcome back to User Friendly Finance with Dave Weaver on News Radio WHP 580.
Hi, this is Dave Weaver and Palm Top. Palm Top. What's Palm Top doing here? Tom Pop. We're talking about the 8 wealth management issues and the subject of investment management, which is one of the first things that people associate with financial planners. But in our case, we like that to just be a part of what we deal with. We like to deal with all the other life issues and stay kind of in line with our True North concept. We just wanted to go back one more time and talk about the fact that SWC Wealth Management is a full-service financial planning firm, and we have offices. We have 2 offices. We're in Palmyra and Carlisle. In Palmyra, we're at 103 West Main. In Carlisle, we're at 35 East High. Both are about a block off the square. You can reach us for either office at 717-706-0700 or via the web at swcwealth.com, and we'll get you in touch with somebody on our staff to go through any questions that you might have. And with that, I guess we'll go back to our subject of investment and investment management, because the next thing we want to talk about is we talked about what happens if you lose $10,000 in a down market. And again, it goes back to being conservative, moderate, or aggressive. A conservative will say, I really feel uncomfortable. I really think I want to sell. An aggressive person would probably be more inclined to say, yeah, I think I'd like to buy more because it means it's a good time to buy. Mm-hmm. Doesn't mean they necessarily would, but it might. That's sort of along the lines of thinking.
And part of our job is to help convince people to stay in it for the long term.
Yeah, if you establish the appropriate time horizon for your if you don't have a change in your personal situation. We talk about this a lot with change in your situation, marriage, divorce, birth of a child, inheritance, a whole wealth of things, or whole, not wealth, but I guess a whole litany of things that can affect what your true uh, allocation is. But those are the things that should change it, not the market. The market going up or down should have very little effect on overall on what your how you're allocated if you've done an appropriate job determining your time horizon and risk tolerance. So, one of the next things that comes into play for people as they're trying to figure out how to invest their money is how important it is for you. Excuse me, how important is it for you to get money on a regular basis?
Yeah, income needs are important. I mean, if you're taking money out of the account or needing to withdraw from your investments on a regular basis, that certainly impacts how you're invested, and and what the portfolio is made up of, and should also reflect in your risk profile as well.
Yeah, because that may mean if you have let's say you have $100,000 invested and you need 4,000 hours over the course of the year, that maybe you don't have any money that's not invested towards generating income. Maybe it's all invested just towards generating income. But if you need money on a regular basis, some of the assets that you have should be geared towards generating that income, and some may be more oriented to the growth part of your portfolio. Whatever money you need to create a specific, consistent amount of income should be different than the money you're investing for the long term.
You should have growth in the portfolio, but you should also have something that's generating income, or at least giving you that steady, consistent return.
Yeah, the ability to create that income without risking the ability to create it in the future, I guess. So I guess that takes us back to the subject of what do you want from your investments? Do you want less volatility? If you want less volatility, just like we talked about risk and return, if you want less volatility, it means you probably have less growth potential. If you don't mind volatility, then you probably have a better long-term growth potential and a little more ability to stomach volatility in the markets. And sometimes you have a combination of both, short and long-term needs. So a little bit of volatility for part of your portfolio and not much volatility for the other, just like we talked about if you're trying to generate income. So when we invest, this is language that's directly out of our questionnaire that we use, is you often have to make a trade-off between risk and reward. The more risk we take, the higher the potential reward, but we also have a higher chance of loss. And the way we typically balance that risk in our portfolio is a mix of fixed investments and equity investments. And the more fixed investments you have, the more moderated your return will be, and the more equity investments, the better your return will be over a longer period of time. But you have to be able to withstand the immediate ups and downs of the market, because the market goes up and down every day. I don't think I've ever listened to the Dow number and said it is exactly zero today. Because
true.
you're dealing with around 26,000 points, and then a penny out of a 26,000, a very small part of it. So it's always changed. I don't think I've ever heard it be exactly the same number.
No, it usually is
or even less than $1. It's usually some amount of change up or down.
It's never exactly flat.
Never exactly flat, which is good. Makes life exciting. Keeps life interesting. Okay, so some of the other, we had a list of things that were included in the things that we wanted to cover under investment management. Return expectations. I think you had talked a little bit about earlier that. Where I think you do want to have an understanding of what returns you might want to get. If you're trying to pay, let's say you have a mortgage that you're trying to pay and it's 3.5% or 4%, and you have an investment that's intended to pay for that, and the things that you want to invest in are, let's say you want to just put it in a savings account, you want to make sure the money's there. But what that tells you is if you're in a savings account and earning 1 or 2 and your loan is 4, you're going to be losing ground and your principal will be going down over time. You're not going to be able to create enough money in that situation.
To pay it all off.
Yeah, to pay it all off. You have to make sure you have enough money to pay it off, knowing that the principal's going down. So you definitely want to understand the return expectations for your investments.
And having those in line with your risk profile too. You can't come in and say, I want to be conservative, but I want to make 10% a year.
Right.
Or, it has to be in line with your risk profile.
Yeah, and those evolve over time. We've been in an extended period where we've had a pretty consistent amount of growth over at least a 10-year period. And over time, returns have looked better than others. There was a time when CD rates were in the 12 or 13% range. You'd be hard-pressed to find a 12 or 13% CD right now. So the times dictate some of that. You just want to make sure that you understand in the period of time that you're in what are good expectations for like a savings account, a CD, a equity index annuity as an example, a variable annuity, and then maybe mutual funds with a mix of stocks and bonds, and get a feeling for those portfolios. There's a huge range of the high 3 years and the low 3 years in any mutual fund. It could be as like an aggressive stock mutual fund may have a high of 40 for a 3-year period and a 40% return over a 3-year period, and a low of 37 for a 3-year period. So you want to know what that range is with the investments that you're looking at. Just because you don't want to be surprised. If it can go down 35%, you should have an understanding of that.
Yeah. And don't look at the return Don't look at the returns of mutual funds first to decide how you want to invest. A lot of people make that mistake. You want to go through those first processes first in terms of defining your goal and time horizon and risk, and then look at the funds and see which ones are performing well, and try to create a balanced portfolio.
Right. And then I guess overlaid across all this is you want to understand the tax implications of your investments. Yeah. Some are taxable, some are not taxable. Some are tax deferred, some are tax free. You want to understand what the tax implications of.
Yeah. And trying to build a tax efficient portfolio if that's what you need to do.
Right.
Yeah.
And that comes into play in almost all these different areas of investment. Education planning, if you're putting money away, that some of it can be tax-free if you're using it for education. Others aren't tax-free if you're using it for education, but your intent might be for that. But there's all different ways across all these different investments, and you want to understand the tax consequences of all of it. So I think that covers our investment topic for the week. If you have any questions during the week, give us a call at 717-706-0700, via the web at swcwealth.com. Tom, they can come see you in Carlisle. They can come see me in Palmyra, or they can mix and match.
Either way. Yep.
Either way. We'll meet you where you want to meet. And we'll be back again next week with User Friendly Finance.
David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm.